Good afternoon. This is Tom McCarthy from McCarthy and Cox, and I welcome all of you to this, the first of a series of webinars we're going to be doing for our clients over the next month. Just so we don't forget, today is Veterans Day, and I would encourage you to thank a vet when you see them. It is an important day, especially with everything else going on in the world. We need to give thanks for many things, and the veterans are certainly one of them. Just to give you a brief look ahead, we'll start today with after the election, now what, talking about the economy. We're fortunate to have with us Brad McMillan, the Chief Investment Officer from Commonwealth. Many of you know him because he's spoken to us many times before. He's actually been to our community on several occasions, and you may see him on TV as well. Next week, we want you to keep an eye out to register for that webinar. It's going to be the election's over now. What regarding politics? How much of the Biden agenda will likely be enacted on health reform, taxes, immigration? We'll have a expert from Natixis, their government relations person, talking about the politics in Washington and what we should be looking for. Then we'll skip a week, but starting the week after Thanksgiving, on that Wednesday, we're going to be talking about investments and investment opportunities and investment risks. Our featured speaker that day will be Bob Berry from First Trust. He's their chief market strategist. That should be an exceptionally good session as well. And then our last in the series will be talking about tax planning, year-end tax planning, as well as what will a new administration mean for tax planning as we look to the future. So keep an eye out for those webinars. Please register early because we have limited space on these webinars. So with that, I'd like to turn over today's presentation to Brad McMillan, somebody whose opinion we value very highly. I know that we live in a very politically charged environment. Brad is going to tell you he's politically agnostic when it comes to his assessment. You may or may not agree with his conclusions, but I think you need to take to heart what he has to say, because I think it'll be helpful for all of us as we manage portfolios and look to the future. So with that, Brad, I'll turn it over to you. Oh, one other thing before I forget. As the webinar goes today, in the bottom, if you look on your screen on the right-hand side, there's a chat box where you can type a message. We'll be taking your questions, and at the end of Brad's presentation, we'll be asking Brad questions that you've all submitted. So if something comes to mind, please type it, send it in. We want this to be an interactive session. So Brad, now it's all yours. Thank you for being here. We really appreciate you carving out some time for us. I know you're really busy, so thank you in advance. We really appreciate it.
Well, it's my pleasure, Tom. Again, thank you so much for inviting me. Thank you for having me here. As I said last time, it's an honor to be invited. It's a much bigger honor to be invited back. So thank you. I'd like to start by echoing Tom and thanking the veterans in the audience here for your service. You know, the reason that we are sitting here able to do what we do is entirely because of your sacrifice and your service, and we should all always be grateful for that. So today is a very good day to honor that. What I'd like to start off with, though, is also to emphasize a point that Tom just made. When I speak here today, I'm speaking as an economist. I'm speaking as an investor. I'm not speaking as a citizen. As a citizen, you know, obviously that's a different lens. But as an economist and as an investor, somebody who working with Tom and Jim and their team, my job is to think about the economy and the markets and what is likely to happen and what can go wrong and what to do if it does. So in that sense, I am completely politically agnostic. I have lots of opinions, happy to share them over a beer or something, but when I put on my investor hat, this is what I'm looking at. I'm looking at your investments and your financial future. And because of that, when I look at the election, I'm looking at something very specific. Not who won or who lost, but more what policies are likely to take effect and what will they mean for your investments. And in that sense, despite the concerns that many people have had about the election on both sides, the news is actually pretty good. Because when you look at who won, we have a Democrat president. Joe Biden won. Again, that's still playing out, but that really seems to be the way to bet. And a Democratic president typically means more spending, which has historically been good for growth and good for the economy. So that's one of the reasons markets are reacting positively. But the other thing is that we also got, very likely, a Republican Senate. And that's going to constrain some of the downsides of a Democratic president. We're not going to see the tax increases. We're not going to see most of the regulation increases. In other words, with a Democratic president, the market sees more good stuff, more spending, more economic stimulus. But with the Republican Senate, the market seems less bad stuff, less taxes, less regulation. And because of that, from a policy perspective, as an investor, I'm saying, wow, I'm getting lots of candy and not very much in the way of vegetables. And when you look at it that way, it's really not a big surprise that the market is cheering. The other thing that I'm looking at as an investor, as an economist, is, first of all, we have a pretty good policy environment going forward, just based on the election results thus far. The second thing is, to a large extent, it doesn't matter. The economy grows regardless of whether you have a red government or a blue government. This goes back 70 years. What I've done here is it's real, the real economy. I'm taking out the effects of inflation. I'm also putting it on what's called a logarithmic scale that lets you better see the regular percentage increases. And what you can see here, it doesn't matter. Republican government, mixed government, Democratic government, the economy just keeps growing. Yeah, we do see some downturns, but they're generally not politically related. 2008, for example, or the early 1980s. So when you look at this, the economy is largely independent of politics. It may not seem that way with all of the headlines, but that's what the data shows us. So from that perspective, over a period of years, it really doesn't matter who's elected. Everything comes out in the wash and the economy keeps growing. So that's one very good thing that we can tack in with the fact that we now have a very favorable policy environment. Because that also shows us that when we look at the markets, we also see consistent growth. And again, it doesn't really matter who's in office at a time. Sometimes the Democrats oversee an upswing, sometimes the Republicans do. Generally speaking, there are outside factors that determine upswings and downswings beyond the general trend. But the general trend is consistently up. And that's very likely to continue given the policy environment we can expect over the next couple of years. And it's not just me saying that either. This is how history has played out. When you see here historically, both Democrats and Republicans have seen positive returns, strongly positive returns. Democrats as presidents in general do better. Republicans generally do better if they sweep the government, whereas Democrats tend to do better with split government. And again, this is all history, so it doesn't mean anything, but it's very consistent with the policy that we went through before. If you have a Democratic administration with a split Congress, you get a lot of the good stuff and very little of the bad. And look at that. You get returns on average of 13% a year. In other words, with Biden elected with a Republican Congress, that's actually a recipe for a fairly healthy market going forward. And while the story isn't over yet, we still might end up with the Democrats taking effective control if they win both Senate seats in the Georgia runoff. First of all, that's very unlikely to happen. And again, that's just me, that's the betting markets. They have to win both of them, not one. Second of all, even if they do win both of them, you're going to have a situation where you're going to have a 50-50 tie, the vice president breaking the tie. And there are a handful of Democrats that are actually fairly conservative. So any way you look at it at this point, it looks very likely we're going to be set up for a favorable market environment going forward, at least from a political standpoint. But when we look at the economy, there's also reason to believe that things are getting better. And I want to go through this kind of big picture overlay. We're going to get into the details in a couple of minutes, but I think it's important to lay out a lot of the positive factors that are out there, despite the risks. So when we talk about jobs, you hear a lot about how jobs are down, and they are down considerably, but they've also grown significantly over the past several months. And this is important, job growth has actually continued and even ticked up a bit, even as the third wave of the pandemic has gotten worse. In other words, the economy is starting to adapt to what's going on. And historically, when you go back here, you can see that when job growth starts again, the recession is over. You can see here these dark streaks, those are the recessionary times. And when you can see job growth starts going up again, the recession is over. And that's been the case for the past 4 recessions. Well, guess what? We've seen job growth pick up significantly, and that growth is continuing. So there's reason to believe the recession might be nearing its end. When we look at consumer confidence, we see the same thing. When consumer confidence drops about 20 points year on year, here, 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 and here, we have a recession. And when it gets back up above that, back up above about 25 points down year on year, we get a recovery. And again, you've seen this in the past 4 recessions, and look here. We are right on the cusp of moving into expansionary consumer confidence again. That's remarkable, but it's also consistent with better job growth. So here's another indicator that has been 4 for 4, saying things may very well get better over the next couple of months. And when we look at business confidence, we see the same thing. This is what's called a diffusion index. Below 50 is bad. Business is scared. And you can see that it's predicted the past 2 recessions. Right now, business confidence is actually higher than it was in 2019. It's as high as it goes back to 2018. In other words, business thinks that things are actually pretty good. And that's consistent with confident consumers. That's consistent with ongoing job growth. And in fact, that's even starting to show up in the biggest picture of all, which is the interest rate market. You can see here when the yield curve inverts, something you may have heard of, we get a recession. But then when it comes back, particularly when it gets up to about 3/4 of a percentage point, the recession is over. Well, guess where we are right now? One more indicator that in fact, things are overall much better than they would appear. And we need to keep this in mind going forward, because that's not what the headlines are telling us. But to really understand the picture, this is where we're going to come out. Things are actually much more positive than what we might think reading the papers. But to really understand where that comes from, we need to dig a little bit deeper and go into the details. There's a couple of big picture items that I think there's one big picture item that I think everybody knows. The medical risks are rising. The third wave is spiking. Case growth is rising faster. In fact, it's been going up week on week for the past 8 weeks. It's going to keep getting worse because it's at multiple state level outbreaks. In other words, the pandemic's not going away. The pandemic is going to get worse. We will get it under control. We do know what to do, but it's going to get worse before it gets better, and we need to keep that in mind. But despite that, the economic recovery is continuing. The job market is improving. We saw that. Confidence is holding. We saw that. And all of this is despite the medical risks. This says to me that the US economy is adapting to the pandemic. No, we don't like it. No, it's still a risk, but we're figuring out how to deal with it. Companies are working out how to make things work. And because of that, the recovery is going forward, and the markets are expecting that to continue. They're expecting growth to continue. And I think the markets are very likely to get what they're expecting. But let's dig a little deeper. We can see here right now we have about 22 states. We're looking at the middle column here, all the red, 22 states that are at all-time highs for case growth. That's a problem. We see daily new cases rising and you see the slope going up. In other words, the curve is not flattened anymore. The curve is rising. And we're seeing testing up. We're seeing the positive rates up right now. And in fact, we're seeing positive rates at a level higher than what we saw in mid-July. In other words, the third wave is real. The third wave is getting worse. But I would point out something. First of all, we know how to control it. We've done it twice before. When you go here, we brought the infections down. When you go here, we brought the infections down. We know what's causing the faster spread of the virus. Behavior. We know if you mask up, that cuts transmission rates. We know if you social distance, that cuts transmission rates. And you can see here a very clear relationship between mask wearing and the spread of the virus. You can see here a very clear relationship between social distancing and the waves of the virus. And the bad thing is we're not doing it. The good thing is we do know what to do, and it works if we do it. And we'll start doing it. In fact, Utah just yesterday announced limited shutdowns. Minneapolis is talking about the same thing. A lot of other states are starting to do that, and you're seeing people change their behavior again. This is what we saw in earlier waves. We will get this under control, but because it's wider spread, it's going to take some time. And that's why I say risks are rising, because we do see the spread rate rising. We do see the geographic spread rising. But the good thing is every time we've seen this before, it did induce people to change their behavior. And that will happen. So something we need to watch out for, something that will ultimately roll over and be brought under control. But the good news is that the economy is continuing to expand despite that, despite the fact that we're starting to see some reopenings reverse. Even with the reversals, even with states that are still closed, we still see that expansion. So there's some upside opportunity here. And to get a little more into the detail on the job numbers, what we have here is a situation where, yes, we saw a tremendous drop in jobs. Then we saw a bounce. But right now, we're still seeing jobs continue to be created. Despite the pandemic. In fact, right now, job growth is about what it was before the pandemic. The healing continues. And if we continue at this pace, which seems reasonable, we should be back to something approaching normal within a year and a half. In other words, yes, things have been bad, but things are getting better. And we can see the end of the tunnel if things keep going. Same thing with layoffs. Yes, they're still very high, but they're dropping. And they're dropping even as the virus continues to rage. We're adapting. The economy is resilient because companies are figuring out how to make it work. I don't know how things are where you are, but in my town, you might say we're halfway back. But what we have here is we have a V-shaped recovery that's going to continue. And because of that, we've seen consumer confidence drop and bounce. And in fact, it's still holding. It's even trending up. And that's a good sign. We see spending growth. And I think this is interesting because when you look at it, this goes back to before the pandemic. And one of the real questions is, what is the effect of the expiration of the $600 federal supplement? When you look at this, you can see that spending came back, and when that expired, it dropped again. But I would call to your attention that it's still at or above the level that we saw before the pandemic. In other words, things are still better than they were, despite everything. And in fact, when you look at the spending of everybody, It's leveled off. We're still not back yet, but we're awfully close. And when you add in business confidence is strong and the recovery still keeps coming in better than expected, I think the future is a lot brighter than people think. And that, I think, is the real takeaway. Yeah, there are risks out there. The medical risks are rising, but the recovery is still moving forward. And in fact, there may be some upside out there because earnings are coming in much better than expected. They're expected to go back into positive territory next year, and we might beat that. Stock prices are awfully high. When you factor in everything that's going on with the low interest rates, the federal support, the central bank support, and the fact that companies are indeed adapting to what's going on, it doesn't look quite as crazy. And when you look at that, that's looking backward. That's all looking backward information. Medical risks are rising, but the economic recovery continues. The stock market's moving back up. But we also have some upside here. Everything I've talked about, we're moving out of the recession. Things are getting better. What if we get a vaccine? We just got really good vaccine news the other day. What if we get more federal stimulus to help jumpstart this recovery? Well, Senator McConnell spoke about that the other day. In other words, things are better than they look, and chances are they're going to get better yet going forward. And that's what the markets are reflecting. That's why we got the kind of bounce we did. Now, that doesn't mean we won't get volatility. Of course we will. There's going to be good news. There's going to be bad news. Headlines are going to hit. But at the same time, just as we saw in the earlier charts, I think there's reason to believe the overall trend will be up. Not just in the long term, but potentially in the short to medium term as well. With that, I will hand it back over to Tom, and thank you so much.
Brad, thank you. As always, you have a way of framing these issues that even I can understand them, so I appreciate that very much. We have a number of questions that have come in, and I will remind all of you on your screen, you'll see a space that says questions. Please feel free to submit your questions, and I'll do my best to get as many of those asked to Brad as we can. And I think, Brad, you've addressed many of these, but I'll still reiterate them because we had several people who essentially framed their question that they're very concerned, despite everything you've shared, that Biden won. Looking back, when Trump won, the markets rallied after the election, even before he took office, because of a promise of lower taxes, less regulations, and support of business. Mr. Biden has promised virtually the opposite. Why won't we have the opposite result?
It's a very fair question, Tom, and that is one of the principal things that investors as a group were worried about before the election. So, the person who asked the question, great question. Absolutely get it. The question, the answer though is yes, that maybe that's what Biden would like to do, and that is what Biden would like to do. When you look at his platform, that's explicitly what he promised to do. But can he do it? And that's what I was talking about, because to do it, he needs to be able to put legislation through Congress. And with Republican-controlled Congress, Republican-controlled Senate, he can't. So in that sense, I don't care what he wants to do. It's not going to happen. I talk with a lot of people about different things, people from investment banks or political consultants. And the phrase I've heard about a dozen times now is dead on arrival. The Biden tax plan, dead on arrival. The Biden spending plan, a lot of it is dead on arrival. I'm sure he wants to do it. I'm sure he would do it if he could. He can't do it. Now let's look, as I said, what happens if the Democrats win both of the Senate seats in Georgia? Then they'll have 50 seats with Vice President Harris. They'll have 51 votes. Well, guess what? That doesn't mean they have 51 votes, because Senator Manchin from West Virginia often votes with the Republicans on things like taxes and spending. There are other Democrats out there that, again, are in states where it's not a good idea to vote for tax increases. For the Democrats to really be able to do what they want to do, they need more like 54 or 55 votes. And there's no way they're going to get. So would he do it if he could? Yeah, he would. He said he would. Can he do it? Nope. So I think it's a legitimate concern, but it's not an immediate concern.
Thank you. A second question has to do with the pandemic and the fact that this third wave is happening locally in our own community. Brad, we're having record numbers every day. We're told that the Columbus hospitals are full. They're short-staffed because many of their staff have caught the darn bug.
Yeah.
The question, we have several of these that essentially say the same thing. You mentioned that economic growth and politics are generally have been independent of each other to some extent, but how would a strict national lockdown impact the current rebound?
A strict national lockdown would take the economy back to where we saw in the second quarter. If we got a strict national lockdown, that would essentially shut down large chunks of the economy again. And that would be a huge hit to the economy. So there's two questions. First of all, will it happen? Second of all, would it be as bad as it was last time? I think the answer to both of them is no. Politically, the president, even should he want to do it, doesn't have the authority to order a national lockdown. That is handled at the state level at most, and often just at the municipal level. There's been a lot of battling back and forth between different governmental levels. Right now, control seems to rest at the state level. So I don't think we're going to see a national lockdown. We might see state lockdowns. As I say, we're seeing something similar in Utah right now with the Republican governor, by the way. But at the same time, that is a much more nuanced lockdown than what we saw. It lets businesses stay open. It lets businesses continue to operate. In other words, it's not the slam down that we saw last time. It's much more of a needle than a meat axe. So A, a national is not going to happen. B, if it does happen, it's going to be at a state level. It's going to be more nuanced to allow businesses to operate. We've learned something from the last one. And C, it's not just the government that's learned something from the last one, it's businesses themselves. Right now, restaurants, and I'm using them as an example because they're one of the most vulnerable sectors, have in a lot of cases figured out the takeout model. They've learned to operate something close to profitably without having people in. And so they're in a much better position to move forward if we did have a series of state lockdowns. The other thing I think is you can't consider the idea of a lockdown in isolation. You know, if President Biden, for example, were to encourage states to have their own lockdowns, and as I say, that's all he could do, that would very likely be in conjunction with more federal support programs, you know, providing the kind of financial support that the states can't. And if that were to be the case, then certainly that again would help mitigate the damage. So I don't think we're going to have another national lockdown. I think we will have state lockdowns, but those are going to be nuanced and there's going to be more support available. It's a headwind, it's not a cliff.
Next question, Brad, and in fairness to you, we're going to have a session the first Wednesday in December that'll more closely address this question, but I think it's on everybody's mind. With Biden's stated policy priorities, are there any particular segments of the economy or the market that we should be looking at because they likely could benefit from a Biden presidency?
I think healthcare in general is going to get a tailwind. You're going to see more funding for healthcare in one form or another. I think that's going to be a positive, but there I think you're going to have to watch out for pharmaceuticals because there's bipartisan support for putting in pricing restrictions on federal purchases of medicines. So I think that's a split thing, but I think those are that's something to hope for and something to worry about. I think infrastructure is another big bipartisan area where the parties can agree. I think that's going to help infrastructure companies. I think there's going to be, money going into bridges, roads, because that's something that needs to be done. It's consistent with both parties' priorities. And third, I think housing is going to continue to do well, simply because, again, that's something that really reflects both parties. I think the overarching theme here is anything that has bipartisan support and can help stimulate the economy, that's where you want to be placing your bets.
Okay. I'm not really sure exactly what this question is asking, but I'll pose it to you. Our country remains ideologically separated and passions are running deep. How do we solve that divide, and is an economic civil war a possibility?
First of all, I certainly understand where the question is coming from, and it's something that I mentioned earlier, the distinction I draw between my economist hat and my citizen's hat. So, that's one of the principal concerns I have as a citizen. What I find interesting, though, when you take discussion away from the party identification and you just focus on issues, there's a much stronger centrist component than you would think just looking at the party IDs. In other words, when you talk about, I mentioned some things that there's strong bipartisan support on just a couple of minutes ago. On a policy level, there's much more agreement than anybody thinks. I think a lot of the back and forth has to do with people trying to emphasize positions that distinguish them from the other side rather than the ones that they share. So I think the distortion, while real, is more perception than anything else. So I'm not sure how to solve it, simply because from a communication perspective, a lot of the things that are out there, social media, the various networks, that's something that really emphasizes division. One thing we might be able to do is put the right of reply back in. There used to be a law where if you made a political statement, you had to give the other side time to respond. And if that was the case, you could have people from the right on CNN and you could have people from the left on Fox. And that would force different audiences to hear different views. We could remove anonymity from social media. You should be able to know who's saying what. I think to me, that's an absolute no-brainer. In terms of a civil war, I think that's overstating the case. There simply isn't the kind of overarching regional issue that led to the last civil war. There's no equivalent of the slavery issue now. And because of that, there's nothing really worth fighting and dying over for 99% of the population. Civil war, I don't think so. Continued politics, yeah, very probably. But the other thing is we're starting to see a younger generation come up, which seems to have different policies and different priorities than people of, say, my age and older. And that alone, I think time is going to change the discussion. I mean, when you look at the parties of this election are not the parties of even 4 years ago or 8 years ago. They're very different parties, and that's going to continue to change. Not a very good answer, perhaps, but that's what I got.
No, I think you did fine. We've had two people ask about the spending. The one reads, our government has spent trillions already that we don't have, and is looking to spend trillions more on top of the record deficit spending. Why don't we see inflation, and does the national debt even matter anymore?
I'm going to say something which is going to come out as heresy to a lot of people, and it's not quite as extreme as it sounds, but it's pretty close. And I'm going to say the national debt doesn't matter unless and until it creates inflation. Because as your questioner rightly says, we spent all this money and we're not seeing any inflation. Let's take a step back. What is inflation? Inflation is the quantity of money chasing the quantity of goods. If you throw more money into a system and the number of goods remains constant, the prices in dollars is going to go up. And that's what we saw with housing in 2008. We made mortgages very easy to get so people could spend more. So they did spend more. So they bid up houses because the supply of houses didn't change that much. And that's what causes inflation. So when you see the current situation where the money is flowing in, but prices aren't going up, then one of two things has happened. Either the money isn't really going into the system, or there's no shortage of things. And what we're seeing right now is both of those are the case. In terms of the money that's going, say, straight to the unemployed, they're going out and buying stuff, but that's just replacing the money they're not earning. There's no additional demand. There's no inflationary pressure there. Whereas for the money that goes into the Federal Reserve's programs, that's simply sitting in the banks because companies aren't really borrowing. They have enough cash. And again, I can give you a concrete example of that. Suppose I gave you $10 million, okay? You'd say, wow, I'm rich. But then I said, you can only spend $5 a day. Yeah, you get the 10 million bucks, but you can only spend $5 a day. All of a sudden, you're not really rich because your spending is constrained. So when the Federal Reserve puts money into the economy, but it doesn't get lent out, that's the equivalent of giving somebody $10 million, but they're only spending $5. So those two things here, at some point, that spending could create inflation, but only if it starts to circulate in the economy. It's not doing it yet. At some point, that spending will create additional demand, but it's not creating additional demand as long as it's just replacing income that we don't have. And that's where I think we are right now. In terms of whether the debt matters or not, there's a lot of people, and I've been one of them, who has said, yeah, at some point it's got to blow up. Well, at some point, I'm sure it will. But we've seen Japan doing this for 40 years. We've seen Europe doing this for decades. We've been doing it for 20 years. And it hasn't blown up. So if it's a slow poison, it must be a really slow poison. The better question, I think, is what would happen if it were to start blowing up? And there, I think you'd start to see interest rates rising again. You start to see the dollar moving down. But until we see one or both of those happening, and I can get into a lot more detail on this, you know, if anybody wants to take an hour, but until we see that happening, no, it doesn't matter.
This is an interesting little follow-up. As you were talking, we got this, and I don't mean to make this argumentative. I just think it's anecdotal, and it's kind of a fun point of. I recently was at Kroger's, and the price of mac and cheese went from $1 to $1.69. Isn't that an indication of inflation starting to catch up with us?
It might be. It might be. But a couple of things. First of all, the food sector is one of the few areas where we have seen inflation. So, and the reason for that is the demand structure of the food industry has changed. Large segments of the food industry were designed to serve restaurants. Well, guess what? A lot of that went away. So their cost structure has changed. They've had to charge more. A lot of the distribution network has been changed because of COVID. A lot of the demand structure on the family side has changed. You know, people are buying a lot more stuff to cook at home because otherwise they might have been ordering out. So a lot of things have changed in that industry, and you're quite right. In that industry, we are seeing more inflation. And there are other sectors where we're seeing more inflation too. Housing, for example. Demand for housing, you know, what I was saying earlier, with interest rates where they are, people can borrow more and pay more, and there's only so many houses. So we're seeing housing inflate. So there's certainly sectors where we're seeing it, and food is one of them, but at the aggregate level, not so much. But you're certainly going to see signs of inflation in different areas.
We've had this question in a couple of different formats. The stock market clearly rebounded. You called it a V-shaped recovery. But how do we know what's a fair price for stocks when earnings are so unpredictable and companies are holding guidance?
That's why I have my job. A better answer for that is simply this. Because the truth is, I don't know the answer to that question. we've seen the value of stocks vary by 30 or 40% in a period of weeks. We saw that this year. So to say that there's a right price for stocks and the market sets that price, I don't think it makes sense. So from that sense, you can argue the market is very richly priced. And indeed, I showed you a chart that said that. But at the same time, you have to take a couple of other things into account. You have to take into account the fact that interest rates are currently close to all-time lows. You don't price stocks in a vacuum. When you're investing your money, you're looking at returns versus different assets. The U.S. Treasury bond is risk-free. If that pays 2%, then you're going to want stock returns of at least, say, 5-6%. But that's someplace where if the Treasury bond was 10%, you'd want stocks yielding 15 or 16%. So the lower the Treasury bond goes, the more you can pay for stocks. And in fact, the more you have to pay for stocks. So with interest rates where they are, that forces stock prices up quite a bit. Second of all, and this gets a little bit technical, but one of the things you've heard about is all these tech companies are doing so much better. That's because they're going to grow in the future. And with lower interest rates, future earnings are worth more. So in other words, there's good financial reasons why the stock market has done as well as it has. Is that going to hold in the future? Probably not as much, but it will also provide considerable support on the downside.
I think we have time for this last question, Brad. We really appreciate your candor and all you've shared with us. Looking ahead, what are the keys to continued economic growth that you're looking at? I think if we all just followed your blog, we'd probably be able to know that, but what are you looking at and what are you focusing on?
When I look at growth and risk, there's four things I look at. There's job growth. Because when you talk about the economy is all of us. We make money, we spend money, that's all the economy is. And where do we get the money to spend? We get it from our job, or we get it from our savings and investments from our previous job. So job growth is the one best sign of an improving economy. Second of all is consumer confidence. Just because you have a job doesn't mean you feel good enough to spend. So if people are feeling better about the world than they did a year ago, that's a positive sign. If they're feeling worse about the world, that's a negative sign. Those two factors define the consumer sector, which is over 2/3 of the economy. If you look at those, that will tell you where the economy is going. Beyond that, you have the business sector. We talked about the confidence level of business. Are they hiring? Are they investing? We talked about interest rates. How easy is it to borrow money? Those four things are the best indicators, both individually and especially as a group, of where the economy is going. And in fact, I do a monthly report on the blog where I look at those as risk indicators. And right now, as I say, things are looking better.
Well, Brad, one more question snuck in, and we've got 2 minutes, so I'll throw this one at you.
I'll talk fast.
Is there, what are the chances of a currency change in form? The examples are Bitcoin or Ameridollar becoming more widely used, and the impact for federal monetary policy.
I think the chances of Bitcoin and other cryptocurrencies becoming more widely used are probably pretty good, but that doesn't give them privileged status. In other words, that just makes them more like gold than anything else. There's a narrative out there that Bitcoin's going to replace the dollar. No, it's not, any more than gold is going to replace the dollar. And this gets into another question I often get asked, since I have, I don't know, 1 minute and 20 seconds left, which is simply that, is the dollar going to collapse? Is Bitcoin going to replace it? To which I would ask the question to you, is Amazon going to collapse? Well, Amazon has a dominant market presence, but couldn't Walmart take it over? Yeah, okay, they probably could, but Amazon would have to screw up for a long time. Walmart would have to be demonstrably better. And the same dynamic applies to the dollar. You can't replace something with nothing. And right now, Bitcoin isn't big enough, isn't widely spread enough. It can't replace the dollar. And the same applies to every other currency out there. It applies to gold, to the yen, to the euro, to the yuan. There's a lot of reasons. So that's the follow-up to that question. So hopefully I can get the follow-up in there too.
You did well. And Brad, as always, we thank you for your time. I know you've got a couple of presentations you're going to be doing through our national conference, and you're also going to be, where will people be seeing you, on CNBC, or where's Brad going to be showing up next?
I'm on Yahoo Finance tomorrow. I'm on CNBC on Friday. And honest to goodness, I have no idea what I'm doing next week. I just want to get through this week.
Well, we appreciate your time, and as always, your candor. You've done a good job answering our questions. We weren't able to get to every question, so I apologize to our audience for that, but we appreciate your time. We appreciate you all being here today. And I would encourage you to keep an eye out for the emails that will be coming out for this series. Our next webinar will be next Wednesday at noon, and we'll be talking to a political analyst about where's the world of politics going to take us. It should be informative. I think you won't want to miss it. So Brad, with that, thank you. Have a great day. And to all of you, have a good Veterans Day, and thank a vet. We appreciate you being here. Take care, my friend. Bye-bye.
My pleasure, Tom. Good to see you.